Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest episode of InvesTips from the CIO's desk. Last time out, we discussed mutual funds in a broad sense and how they're a great way to invest. Today, I want to narrow the conversation a little and talk about equity mutual funds in particular. Now, there are an estimated 45,000 open-ended equity mutual funds available globally, and despite the dramatic rise of exchange-traded funds, they remain the cornerstone of most equity portfolios, and for good reason. They offer an easy and efficient way for investors to build a diversified equity portfolio at relatively low investment amounts. Now, as with any equity-related investment, they can be risky in the short term due to the risk of either a weak performance of equity markets or due to fund manager underperformance. However, they can be an instrumental way to deliver strong returns over the long term, helping investors generate the nest egg required for retirement. When considering which funds to invest in, there are at least 4 dimensions that you need to consider when thinking about building an equity portfolio. So the first lens is the active versus passive management conversation. In short, active managers try to outperform their chosen benchmark, which in itself is important when it comes to the other 3 dimensions we'll talk about in a moment. They try to outperform their chosen benchmark by conducting a lot of research into companies and having a higher allocation to stocks that they think will outperform, and vice versa. Now, of course, this research requires significant resources in terms of people, and therefore the costs are typically higher. Passive managers, on the other hand, just try to replicate the benchmark as closely as possible, and this reduces their cost. Therefore, if you choose an active manager, you want to make sure you're getting what you're paying for, which could be in terms of outperformance or a specific style or focus of the investments. The second lens is growth versus value investing. Now, value investing focuses on companies that are relatively cheap to the net asset value of the company, while growth focuses on companies that are expected to grow strongly in the coming years. Now, growth has outperformed for most of the past 15 years, but that does not mean it's going to do so in the future. Also, growth companies trade at a premium to other companies, which can mean that the downside risks of volatility is greater. So it's important not to be all in on either approach and have a calibrated allocation to both styles, both growth investing as well as value investing. The third thing to consider is whether the fund has a tilt to very large or large cap companies or to more smaller companies. As they are still equity focused, they will both be volatile. But smaller companies, while they have better long-term upside, this usually comes with significantly greater volatility as they tend to be less mature and more vulnerable to economic and financial swings. Therefore, we believe the majority of your equity portfolio should focus on large cap companies, especially as you start out and you're learning about your emotional intelligence when it comes to fluctuations in the value of your portfolios. The final area is a catch-all thing to consider. Many funds narrow their universe significantly. For instance, some will invest in a specific geography, whether that's a region or even a small country, or sector funds. So they might be invested in tech, or they might be in healthcare, or they might be in the materials or mining sector. They could also approach investing from a different perspective, such as ESG or impact funds, high dividend yielding stocks, or take a factor approach to building stock portfolios, such as momentum or low volatility. Now, in some cases, these may be a lot less diversified in nature and therefore can entail greater volatility, making it harder to ride through the cycle. Therefore, once again, a calibrated approach to narrow and volatile areas of the market makes total sense. If you're starting out on your equity investment journey using mutual funds, we suggest you start with large capitalization funds which are diversified across sectors and ensure diversification across geographies as well. You can achieve this either through a global fund that is a one-size-fits-all, or by combining different regional funds into a portfolio. So I hope that gives you some sense of how we would think about using equity mutual funds to build your long-term financial future. Obviously, there's a lot of things to consider, but I think if you go through these 4 steps, it will really help you make smarter decisions. So thanks so much for joining us today. Next time out, we'll shift the conversation to bond mutual funds, which we'll look at in more detail. I look forward to catching up with you then. Please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.